Imagine waking up tomorrow morning and every major news channel is reporting the same headline. A major war has just begun. Within minutes, the stock market opens and billions of dollars disappear. Red numbers flood trading screens. Investors panic. Social media is filled with one message: sell everything before it's too late. But here's the question: what if that's exactly what history says you should not do? It may sound unbelievable, but some of the greatest long-term investment opportunities have appeared during periods of war, global crises, and extreme uncertainty. From World War II to the Gulf War to the Iraq War and even more recent geopolitical conflicts, the stock market has repeatedly surprised investors. So what really happens when war breaks out? Do stocks always crash? Should you buy and sell or simply wait? In today's video, we're not guessing. We're going to examine decades of market history, real-world data, and investor behavior to understand how wars have affected the stock market and what lessons long-term investors can take from the past. By the end of this video, you'll have a clearer framework for thinking about investing during periods of geopolitical uncertainty. Let's begin. Whenever war begins, financial markets usually react before most people have even processed the news. Why? Because markets dislike uncertainty. Investors don't just react to the conflict itself, they react to the unknown. Will oil prices surge? Will inflation increase? Will governments raise military spending? Will global trade be disrupted? No one knows the answers immediately. And that's exactly why markets often become highly volatile in the early stages of a conflict. But here's something many new investors don't realize. The first market reaction isn't always the final outcome. History shows that some of the biggest declines happen when fear is at its highest. Yet over time, markets have often recovered from geopolitical shocks, although every conflict is different and no outcome is guaranteed. That's why understanding history can be more valuable than reacting to headlines. In the next section, let's look at what has actually happened to financial markets during some of the world's biggest wars.
Question is, why do stock markets react so quickly to war? To understand whether you should invest during a war, we first need to understand why stock markets react so dramatically in the first place. The answer isn't just the war itself. It's uncertainty. Financial markets hate uncertainty more than almost anything else. The moment news of a major conflict breaks, investors begin asking dozens of questions. Will oil prices spike? Will inflation rise again? Will interest rates stay higher for longer? Will global supply chains be disrupted? Could this conflict spread to other countries? Since nobody has immediate answers, fear often takes over. And when fear dominates the market, investors frequently make emotional decisions instead of rational ones. The first reaction is often panic. One of the most common reactions during the first few days of a major conflict is panic selling. Many investors sell simply because everyone else appears to be selling. This behavior is driven by psychology as much as economics. The fear of losing money often feels stronger than the excitement of making it. That's why markets can experience sharp declines immediately after unexpected geopolitical events. But here's what's fascinating. History shows that the market's first reaction is not always its final direction. In many cases, once investors have more clarity about the conflict and its economic impact, markets begin adjusting to the new reality. Markets price in future expectations. It's important to remember that the stock market isn't just reacting to today's news. It's constantly trying to predict tomorrow. Stock prices reflect what investors believe will happen in the future, not just what's happening right now. If investors think a conflict will be short-lived, markets may recover surprisingly quickly. If they expect a prolonged war with significant economic consequences, volatility can continue for much longer. That's why two wars can produce very different market outcomes. Why some sectors rise while others fall. Not every company reacts the same way. Some industries may face higher costs, weaker consumer demand, or supply chain disruptions. Others may benefit from increased government spending, higher commodity prices, or greater demand for security-related technologies. This is one reason broad market headlines don't always tell the full story. Even during periods of overall market weakness, some sectors have historically outperformed, while others struggled. The biggest mistake investors make. Perhaps the biggest mistake investors make during times of war is assuming that today's headlines automatically determine tomorrow's market. History suggests that emotional decisions made during periods of maximum fear can sometimes lead investors to miss future recoveries. Of course, every conflict is unique, and no historical example guarantees what will happen next. But understanding how markets have reacted in the past provides valuable perspective. So, what does history actually tell us? Let's examine some of the biggest wars of the past century and see how the stock market performed before, during, and after those conflicts. The results may surprise you. Now comes the most important question. What does history actually tell us about investing during a war? Instead of relying on opinions, let's look at some of history's biggest conflicts and how financial markets responded. You might be surprised to discover that the market's behavior isn't always what most people expect. Let's begin with World War II. When the United States entered the war after the attack on Pearl Harbor in December 1941, fear spread rapidly across financial markets. Many investors expected years of economic uncertainty and continued market weakness. But something unexpected happened. After the initial shock, the U.S. economy expanded dramatically as industrial production increased to support the war effort. Factories operated around the clock, millions of new jobs were created, and many companies experienced significant growth. Although markets remained volatile during the war, the U.S. economy eventually emerged much stronger than many had predicted. The lesson? An initial market decline doesn't always determine the long-term outcome. Fast forward to 1991. As tensions in the Middle East increased, uncertainty pushed markets lower. Oil prices surged, and many investors feared a prolonged conflict. However, once military operations began and uncertainty started to decrease, investor confidence gradually returned. Markets recovered much faster than many people expected. The biggest risk wasn't always the war itself. It was the uncertainty before investors understood what was actually happening. The same pattern appeared again in 2003 during the Iraq War. Leading up to the invasion, investors worried about higher oil prices, economic instability, and global uncertainty. Stock markets experienced increased volatility. But after the conflict officially began and uncertainty eased, markets gradually stabilized. Again, investors who made decisions based only on fear often missed part of the recovery. If we compare these historical events, an interesting pattern begins to appear. Markets often react sharply when uncertainty is highest. Once investors gain a clear understanding of the situation, volatility may begin to ease, although the timing and outcome can vary widely. History doesn't tell us exactly what will happen next, but it reminds us that panic and long-term investing often don't work well together. So if wars don't affect every company in the same way, which industries have historically shown resilience during periods of geopolitical conflict? And which sectors have typically faced the greatest challenges? That's exactly what we'll explore next. By now, one thing should be clear. War doesn't affect every company the same way. While some industries face enormous pressure, others may actually experience increased demand. Let's take a closer look at the sectors investors often watch during periods of geopolitical conflict. First, defense companies. The first sector is defense. When governments increase military spending, defense contractors often receive larger orders for aircraft, missiles, radar systems, cybersecurity solutions, and other equipment. Companies involved in defense manufacturing may see stronger demand, although the impact varies depending on government budgets, contracts, and the nature of the conflict. That's one reason investors often pay close attention to defense stocks during periods of heightened geopolitical tension. Second, energy companies. The second sector is energy. Many wars involve regions that play an important role in global oil and natural gas production. If supply is disrupted or investors fear shortages, energy prices can rise sharply. Higher oil prices may benefit some energy producers, while also increasing costs for businesses and consumers. However, commodity prices are influenced by many factors beyond war alone, including global demand and production decisions. Third, cybersecurity. Modern conflicts are no longer fought only on the battlefield. Today, cyber attacks have become an important part of geopolitical tensions. Governments, financial institutions, and businesses often increase spending on digital security during periods of elevated risk. As a result, cybersecurity companies can receive greater attention from investors, though outcomes differ from company to company. Fourth, gold. Gold has long been viewed by many investors as a potential safe haven asset during times of uncertainty. When fear rises, some investors move part of their money into gold, hoping it will help preserve value. That doesn't mean gold always rises during every conflict, but it has often been considered a defensive asset during periods of market stress. The biggest mistake investors make. One of the biggest mistakes investors make during wartime is trying to predict every short-term market move. Nobody consistently knows where the market will be next week or next month. Many investors sell quality companies after sharp declines, only to watch those same stocks recover later. History suggests that emotional decisions made during periods of fear can sometimes be costly. A smarter long-term approach. Rather than reacting to headlines alone, many long-term investors focus on diversification, disciplined investing, and regularly reviewing their portfolios. Some also use strategies such as dollar-cost averaging, investing fixed amounts over time instead of trying to perfectly time the market. This approach doesn't eliminate risk, but it can reduce the pressure of trying to predict short-term market trends. So, after looking at history, market psychology, and the sectors that tend to react differently during conflicts, let's answer the question that brought you to this video. Should you invest in the stock market during a war? The honest answer is, it depends. It depends on your investment goals, your time horizon, your risk tolerance, and most importantly, the quality of the companies you're investing in. Focus on quality, not panic. Instead of asking, should I buy because there's a war? A better question might be, am I investing in financially strong companies that I believe can grow over the long term? Businesses with healthy balance sheets, durable competitive advantages, and consistent cash flow may be better positioned to navigate periods of uncertainty, though no investment is risk-free. If you found this video helpful, don't forget to hit the like button and subscribe for more in-depth analysis on the US stock market, investing strategies, AI stocks, and the biggest opportunities shaping the future of finance. Thank you so much for watching. Stay informed, stay disciplined, and I'll see you in the next video.